What is a central bank digital currency or CBDC? To put it simply, the central bank digital currency or CBDC is a digital version of the traditional fiat currencies that we use today. But money is digital today, right? After all, most of us use payments worldwide without necessarily using cash. So how different is a CBDC from the normal digital transactions that we are accustomed to? Well, to better explain the difference, let me use an example. Let's say, for example, you are shopping for new shoes online, right? You find the brand that you want and order a pair. Typically, you would pay using a bank-issued card. So the merchant who is selling the shoes will basically charge the amount from your card, which will, in turn, be charged directly from your bank account. Once the charge goes through, the money will then be transferred from your account to the merchant's account. All these transactions happen digitally, but more importantly, it is a bank-to-bank transaction. In other words, the payment for the shoes is settled between two banks. But how different will this transaction be if we were living in an era of central bank digital currencies? Well, it is actually simple. You won't need to go through a bank to complete the transactions. In a world where CBDCs operate, everyone has an account at the central bank. Also, each transaction involving each account is recorded in one big public ledger or record. So if I wanted to pay for shoes online, the only thing I have to do is transfer the money directly from my central bank issued account to the merchant's central bank issued account. In essence, the entire transaction goes through without the need for any commercial bank. Think of CBDCs as normal cryptocurrencies, only that instead of being decentralized, they are actually controlled by a central entity that determines supply and utility. So how are central bank digital currencies supposed to work? Now, before we jump into how CBDCs work, I think it's very important to explain briefly how central banking works in daily transactions. Again, let me use an example. So let's say you want to buy a birthday present for a loved one. Naturally, you go into a store and find a nice present and decide to buy it. When you are checking out, you provide a debit card. The card is charged and the money is transferred to the seller's account. Now, what people don't know is that these transactions are not instantaneous. In other words, when the store charges your debit card, it does not actually mean that physical cash has exchanged hands. What happens is that a record showing your bank owes the seller's bank the amount charged for the birthday present is created. These records will be created across the economy all day, and this could amount to tens of millions of transactions. So how does the exchange of money happen? Once all records of who owes who are created, the transfer of funds will be done in 24 hours. This is where the central bank comes in. In essence, the central bank looks at the record of transactions, determines which bank owes which bank money, and makes the transfer of funds. The banks then credit the transfers from the central bank to the individual accounts, minus the fees, of course. But how do CBDCs work in such a context? Well, it's pretty much the same way you transact money digitally now. The only difference is that there are no banks. The central bank directly issues accounts to individuals, and once a transaction is made, the money is moved across different accounts instantly. There is no 24-hour wait period. There are no processing fees. Once you pay, the money goes directly to the target account. What are the potential benefits of CBDCs? CBDCs have proponents and opponents. And I know a lot has been said about the potential risks of CBDCs. However, let's explore the potential benefits that these currencies could actually have. First, CBDCs could play a huge role in financial inclusion. Although in most developed countries, many people have access to banking services in the financial system. In the developing world, things are very different. CBDCs, which will feature central bank-issued mobile wallets, could provide a basis for access to finance in the unbanked and underbanked communities. Secondly, CBDCs could potentially help reduce transaction costs. Since they allow people to transfer money directly from account to account, there will be no need for third-party banks. Besides, this could also mean that transactions are cleared much faster, leading to efficiency in the economy. Additionally, CBDCs could open a new world where people directly relate with central banks and economic planners. This will make it easier for central bankers to align economic policy with people's needs. For instance, we have seen a lot of cases where central banks have issued economic stimulus packages, which is essentially direct cash to stimulate the economy, only for this money to end up with wealthy corporate CEOs. With CBDCs, central bankers will have the opportunity to send stimulus directly to customers and impact the economy more directly. But are there potential risks of CBDCs? Well, despite the benefits, CBDCs are not 100% perfect, and there are some concerns worth noting. But before I jump into these risks, if you're enjoying this video so far, please take a minute to hit that subscribe button right now. Feel free to give us a like and share the video with your friends and family. Moving on, what are the risks of CBDCs? First, it is possible that the widespread use of central bank digital currencies could render the entire banking system obsolete. After all, if you are able to bank directly with the central bank and transact using a central bank-issued digital currency, you won't need any third-party banks to assist. Secondly, there is also the question of privacy. Even with digitized payments, there is a certain degree of anonymity on what you spend money on. In fact, only your bank can be able to tell where and how you are spending your money. Besides, banks are obligated by law not to share this info with anyone. However, with a CBDC, where the central bank manages all transactions, it is easy for the government to keep track of spending habits, something that infringes on the freedoms and liberties of the individual citizens. There is also a lot of worry that CBDCs could give central banks incredible power to control the economy. They may influence spending habits, control the flow of money, and such things. If this power is abused, it could lead to disastrous consequences. But how close are we to CBDCs anyway? Well, although the idea of central bank digital currencies has been in the news a lot, we are actually not that close to the widespread adoption of real CBDCs. For instance, out of all the 89 countries that are considering the idea, only about 18 have taken concrete steps to develop CBDCs. Besides, with the exception of China and Nigeria, all these are smaller countries with smaller GDPs. In most G7 countries, these are basically the most advanced economies in the world. The idea has been floated and debated, but we are still not that close to a CBDC yet. Recap. Before I end this video, let me recap a few things that we have covered today. We started off by explaining that CBDCs are basically a crypto version of fiat money, only that instead of being fully decentralized, central banks control it. We also explained that CBDCs could have massively positive implications in enhancing financial inclusion, reducing net transaction costs, and promoting direct relationships between economic planners and the consumer. The video also looked at the potential risks of CBDCs, including privacy concerns, possible disruptions of traditional banking, and the risks of central banks abusing the power of CBDCs. Well, that's it for today. Thank you so much for watching this video to the end. If you enjoyed every bit of it, please give us a like. For those of you who have questions about CBDCs or any other crypto-related query, feel free to leave them in the comments. As always, don't forget to subscribe, and until next time, take care. Goodbye.